Welcome to Iron Financial, the place you come to forge a stronger portfolio because we stress test the market's weakest links. I'm your lead analyst, and with me, as always, is our market skeptic. Today, we're putting ZIM Integrated Shipping on the anvil. Now, on the surface, you've got this massive all-cash buyout offer from the shipping titan Hapag-Lloyd. That sounds like a home run for shareholders, right? A huge win. But then you start digging, and the financials are flashing some seriously bright red warning lights. The signals are completely crossed. So the question we have to hammer out today is this buyout a premium price for a solid, undervalued asset? Or is it really just a golden parachute for shareholders to get out before the entire structure comes crashing down? Let's get into it. All right, so let's start with the official company line. This is the story they want you to believe coming straight from the top, ZIM's president and CEO Eli Glickman. You got to focus on his keywords here: strong operational and financial results. The message is crystal clear. The company is on solid ground, the leadership is confident, and they're hitting all their targets. This is the foundation, the narrative they're building for the entire market. It's meant to project strength and stability. Whoa, hang on a second. Strong? That's a really heavy word, especially in this industry. We've got to ask, is this company genuinely strong, like a steel I-beam holding up a skyscraper? Or is it just strong compared to the absolute train wreck that everyone on Wall Street was bracing for? You know, here at Iron Financial, we don't just take press releases at their word. We look for the cracks. The first rule of building a strong portfolio is to test the integrity of the materials, not just sit back and admire the fresh coat of paint. We need to get past that polished surface and see what's actually holding this thing together. And look, to be completely fair, this is the exact number that gets the bulls all fired up. This is the data point that backs up the CEO's claim. A monster, 132% earnings per share, beat. I mean, you had Wall Street analysts, the so-called experts, with their complex models, all predicting a loss of about $1 per share. Instead, ZIM turns around and posts a positive EPS of 32 cents. You know, from a trader's perspective, that is a massive upside surprise. It makes it seem like the company is navigating this incredibly difficult market way more skillfully than anybody gave them credit for. It's the kind of number that makes you think, maybe things really are rock solid under the hood after all. But then you just flip the page in that same report. And this is where that whole strong narrative starts to creak and buckle immediately. While yeah, they beat a very, very low earnings bar, the top line, the actual cash coming into the business, well, it fell right off a cliff. We're talking a 32% drop year over year. And let's be crystal clear about the dollars and cents here. We're talking about revenue shrinking from over $2.1 billion in Q4 of 2024 to less than $1.5 billion in the same quarter of 2025. That's not just a little dip, it's a severe, painful contraction. So how can any company be fundamentally strong when its sales are collapsing at that kind of speed? These two numbers just don't add up. It's a massive structural contradiction right at the top of the report. And that right there is the crux of the issue. You cannot and should not build a solid investment case on headlines that completely contradict each other. Sure, an earnings beat is great, but a revenue collapse of that magnitude is a huge, flashing red flag. To really get a handle on the true strength of ZIM's structure, we have to push past the headlines and start deconstructing the company's real performance blueprint, the profit and loss statement. This is where we find out if the foundation is actually solid or if it's just built on a pile of sand. Okay, so let's shift to the full year numbers on this table, because this is where those little cracks start to look like gaping chasms. Let's just go right down the line. First, net income. It's down almost 78%. It cratered from a very healthy $2.15 billion in profit to just $481 million. Next, look at full year revenues, down over 18%. And then you have adjusted EBITDA, which is a key measure of a company's core profitability, and it got absolutely hammered, dropping 41%. I mean, these are not the vital signs of a company that's firing on all cylinders. This is the blueprint of a business that is under severe, sustained, and dangerous pressure. And this bar chart right here, it just paints the picture perfectly. Forget the percentages for a second and just look at the visual. The profit engine of this company has been throttled back to just a fraction of its former power. We're talking from over $2 billion in net income down to less than $500 million. This is not just some normal cyclical downturn in the shipping world. This is a fundamental collapse in the specific company's ability to make money. When the central pillar of your financial structure shrinks by nearly 80% in just 1 year, that word strong starts to sound less like a confident assessment and a whole lot more like wishful thinking. So what's actually causing this collapse? What's putting all this stress on the engine? Well, it boils down to two simple, brutal facts, and they're laid out right here. First, the price they can charge for their services is plummeting. As you can see, the average freight rate they get per container dropped by 29%. Second, they're just doing less business, period. The volume of containers they carried fell by 9%. So let me put that another way. Not only is every single job they do bringing in less money, but they're also getting fewer jobs to begin with. It's a devastating 1-2 punch that goes straight to the revenue line. And it perfectly explains why that P&L is showing so much strain. Okay, so a weak P&L tells us about a bad year, right? It's about recent performance. But the balance sheet, that tells us a different story. That tells us about resilience. It tells us whether the company's entire financial structure is actually built to withstand the kind of brutal storm we're seeing in their profit numbers. With profitability getting crushed like this, is ZIM's financial foundation solid enough to handle the pressure? Or are we about to find even more structural weaknesses? Let's turn up the heat and apply some pressure. And the very first warning sign we see on the balance sheet is right here: leverage. The net leverage ratio is a simple measure of a company's debt compared to its earnings. Back in 2024, it was at a pretty manageable 0.8 times. Fast forward just 1 year, and it's jumped all the way to 1.3 times. What this really means is that the total weight, the total load on the structure is getting heavier, while the pillars that are supposed to be supporting that weight are getting weaker. This is a classic textbook indicator of rising financial risk. Simply put, their debt is growing much faster than their ability to actually pay for it, and that's a dangerous path to be on for any length of time. And that brings us to a much more formal kind of stress test: the Altman Z-score. Now, for anyone who doesn't know, this is a formula that was developed way back in the 60s specifically to predict the odds of a company going into bankruptcy within 2 years. Anything above a 3, you're considered safe. Anything below 1.8, you're in what's called the distress zone. So where is ZIM? Their score is 1.83. They are literally standing on the cliff's edge of the distress zone, firmly planted in what's known as the gray zone. This score is a flashing quantitative warning light on the dashboard. It's the math telling us that this company is showing all the classic characteristics of a firm that's under significant financial stress. And the warning signs just keep piling up. Let's just run through this list of additional cracks in the armor. First, the debt-to-equity ratio is at 1.41, which just confirms the high leverage we were just talking about. But then look at the operational signals. This is the stuff that really makes you worry. I mean, think about it. In the middle of negotiating this massive buyout deal, the company decides to suspend all of its financial guidance for the upcoming year and then cancels its quarterly conference call with analysts. Why would you do that? Healthy companies with a clear future, they're transparent. They want to issue guidance. They welcome the tough questions from analysts. Suspending guidance and canceling calls injects a massive amount of uncertainty into the picture. And then, to top it all off, you get reports of labor stoppages in February, right after the merger was announced. That signals internal chaos and potential disruptions to the business itself. These are not, by any stretch of the imagination, signs of a healthy, stable operation. Okay, now we absolutely have to talk about the dividend. Because in the middle of all this financial pressure, I'm talking collapsing profits, rising debt, a Z-score in the gray zone, ZIM has been paying out these absolutely enormous dividends to its shareholders. Now, the bulls will tell you, see, this is a shareholder-friendly company with fantastic cash flow. But any good skeptic has to ask a very critical question. Is this a sensible reward coming from a healthy, robust company? Or is this a company paying out cash that it desperately needs to be using to shore up its own shaky foundations? And let's be perfectly clear about the scale we are talking about here. Since its IPO in January of 2021, ZIM has shoveled $5.8 billion out the door in dividends. The CEO, Eli Glickman, actually boasts about this. He proudly states this is more than 25 times the amount of money the company raised in its IPO. That is an almost unbelievable return of capital to shareholders. He even points out that once the merger is complete, the total cash returned will be approaching $10 billion. So the sheer size of this payout is absolutely central to the ZIM story. But the real question is it the right story? And this slide right here connects that massive dividend payout directly to the P&L we just tore apart. In 2025, the same year that their net income completely collapsed by 77%, the company still decided to allocate half of its entire net profit, $240 million, to dividends. Just let that sink in for a second. While their leverage was creeping up and their Altman Z-score was flashing yellow, management looked at their profits and decided the absolute best use for half of it was to just send it out the door to shareholders. Instead of, maybe paying down debt or building up a cash reserve for the storm ahead, this capital allocation decision seems completely and utterly disconnected from the financial stress we're seeing everywhere else in the company. And this really gets us to the heart of the dividend dilemma. Are we looking at solid, load-bearing pillars here that are genuinely supporting shareholder value, built on a foundation of sustainable free cash flow? Or are these just decorative gargoyles? You know, something that looks really impressive from a distance, but adds exactly zero structural integrity and is just bolted onto a crumbling facade. It's an absolutely crucial question you have to ask when you're trying to figure out if this company is a sound investment or just a house of cards waiting for a gust of wind. Okay, so if ZIM's structure is showing this many cracks, why on earth would a major, sophisticated player like Hapag-Lloyd come in with a multi-billion-dollar all-cash offer? To understand that, we have to pull the camera back. We need to zoom out from ZIM's shaky internal financials and look at the much broader industry landscape. Because right now, the container shipping industry is a very tough neighborhood, and it's in the middle of this massive wave of consolidation. Understanding that context is the key to understanding the logic behind this buyout. This table from Dynaliner shows you the power dynamics on one single key trade route. And as you can see highlighted there, the number one player by a mile is the Gemini Cooperation, which is Hapag-Lloyd and Maersk. They control almost half the entire trade capacity on this one lane. So Hapag-Lloyd isn't some small upstart trying to get a foothold. They are already a dominant, powerful giant, and they're looking to become even more powerful. In this industry, scale is absolutely everything. The more ships you have, the more routes you control, the more pricing power you can exert on the entire market. And that brings us to the really brutal logic of this industry. This deal isn't necessarily about buying a perfectly healthy, wonderful company at a premium. This is a strategic power move. It's chess. In a consolidating market, the strongest players, the ones with fortress-like balance sheets, they actively go out and hunt for weaker competitors. It's exactly right. By acquiring ZIM, Hapag-Lloyd doesn't just get their ships and their routes, they completely remove a competitor from the game board. They absorb their market share and they fortify their own dominant position. So from their perspective, a financially stressed ZIM isn't a problem, it's a feature. It's what makes them a cheaper, more compelling target for a giant that's looking to consolidate its power. All right, let's bring this all home. We've looked at the conflicting headlines, we've put the P&L through a stress test, we've inspected the balance sheet for cracks, we've questioned the logic behind the dividend, and we've analyzed the strategic game being played in the wider industry. It's time to weigh all the evidence we've hammered out today and forge our final verdict. So, is this Hapag-Lloyd deal a real validation of ZIM's underlying strength, or is it just a perfectly timed golden parachute for its shareholders? Okay, let's lay out the final blueprint, starting with the bull case. The argument here is that this is a solid asset sale. Shareholders are getting a $35 cash offer, which is a clear premium. That big Q4 earnings beat suggests the company still has some operational fight left in it, and it's a perfect strategic piece for Hapag-Lloyd's larger consolidation game. For any ZIM shareholder, this deal effectively takes all the risk of a crazy, volatile market completely off the table. It's a clean exit at a very good price. But then you've got the bear case, which argues this is a necessary escape from an imminent structural failure. The core business is being defined by collapsing revenues and freight rates. The balance sheet is showing very serious signs of stress, with rising leverage and a Z-score that's teetering right on the edge of the distress zone. And then you have management's own actions, suspending guidance, canceling calls, and paying out these wild dividends in the middle of the turmoil, which just scream uncertainty and really questionable capital management. And so we end right back where we started, with the central question that every single ZIM investor has to answer for themselves. Are you cashing in on a fundamentally sound asset that another bigger company wants for its own strategic reasons? Or are you taking the money and running, escaping a business whose financial structure is showing every single sign of being unable to withstand the pressures of this market? The answer to that question will determine whether this deal is ultimately a triumph or a disaster that was very narrowly avoided. Thinking through these kinds of stress tests, asking these tough questions, that's how you forge a stronger, more resilient portfolio. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.